Hello, everyone. It is October 12th, 2022. Today, we're talking with Arthur Hill from TrendInvestorPro, coming to us from Belgium. We'll get a couple charts and ideas that are top of mind for him as the S&P, the major averages, finish right at the zero level. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is designed to help us understand market dynamics by focusing on the message the markets provide back to us. I had a great opportunity over the weekend with ChartCon, talking to people like Ralph Acampora and others, reminding us of the message of price. If you know nothing else about the markets or the world or the economy, focus on price. You can learn a lot just by looking at trends. Today's guest, by the way, Arthur Hill, one of the best, I think, at helping us recognize the message in price. He managed to find something in an uptrend, which I'm excited to hear about a little bit later, because there are not many of those here in the markets. We have other great guests coming up through the course of this week. Tomorrow on the 13th, we have Katie Stockton from Fairlead Strategies in Connecticut. Two great guests to tell you about next week. Hema Reddy is going to be joining us for the first time on Tuesday, October 19th. She actually wrote a book on GAN analysis, so interested to hear how she is thinking about it in terms of price and time cycles. Then on Wednesday, Jeff Huge of JWH Investments coming to us from Minnesota. One other event to let you know about. Next week, I'll be doing the next free webinar with market misbehavior. It's called the Market Bottom Checklist Revisited. Back in June, I did a webinar focused on a market bottom checklist. We identified 10 things, 10 items to watch for to help you anticipate a bottom, identify a bottom, confirm a market bottom. A lot's changed in the last couple of months. We'll update that checklist, look at the current markets, but also relate that to seasonality, because November and December tend to be pretty strong, particularly in a midterm election year as we're in this year. Let's continue on with our show today with our market recap. Let's talk about how the markets have evolved, what we learned from the action today. Yesterday was a really choppy session as we're looking at the two-day chart of the S&P 500. Big spike in the early afternoon yesterday, big drop in the afternoon. Today, really quieter, a lot lower volatility, a lot choppier compared to what we saw yesterday. Finishing in a position of weakness, though, and I think those are, when I'm looking at a day and just trying to summarize it as a longer-term investor, because I'm trying not to play the short term, but I want to understand the lessons that the short term is teaching us about the overall market conditions. I'm interested to see when something tries to go up and fails to do so. I'm looking for spikes upwards and downwards, whether, what's on the move, and try to think about the potential likelihood that continues. But I'm also looking at the end of the day, and it's always interesting to see what happens going into the close, because a lot of times that's more institutions. That would be like ETF rebalances, and a lot of times reflects some of the larger players and where they may be headed. So not a great look to see the S&P, which was flat about half an hour ago, closing at a position of weakness, still only down about 1/3%. So let's not get too crazy. Not a bad day, just above 35.75 on the S&P 500. The NASDAQ composite really flat from where it was, as was the Dow. Mid caps and small caps both down a little bit more, about 0.5% plus. The VIX remaining elevated above 33 here, finishing the day around 33.70. Other asset classes, interest rates, I would argue, have been the story in 2022. I was interviewed in January. I was part of Market Vision 2022, which was an event that Tom Bowley put on, one of our StockCharts contributors through his own firm called Earnings Beats. And I was asked what chart I think would be the most important to follow. My answer was the $TNX chart, right? The 10-year interest rate. Looking back, I think that's one of the better places. Maybe the dollar would have been a better choice, I guess, but 10-year weren't bad, particularly when you think about value versus growth. On a day like today, when you see energy doing well, energy going higher, up 0.8% for the XLE, while more of the growth-oriented sectors like technology going down, the major benchmarks sort of flat to down. Just a reminder what a higher rate environment has tended to do, and those headwinds that you see for growth stocks. Bonds actually opened a little bit lower and then trade higher through the course of the day. You flip that over, and that's what the 10-year interest rate, this is the 30-year we're looking at here, moving higher and then sort of going down through the course of the day. 10-year yield finished today right around 390 toward the lows of the day, still pretty elevated relative to the last couple of years for sure. And 4%, sort of that really interesting level of resistance. We've approached that a number of times here, but not quite been able to get above there. Flat for the dollar as well. Gold price is going higher, about 0.5% higher on the GLD. Silver is about 0.5% lower, so sort of a mixed bag overall when you look at commodities. As I mentioned, energy stocks were up in a pretty much better than the average stock today. Finally, we have Bitcoin and Ethereum both in the positive, but not by much. It's been quieter for the cryptocurrencies, and by a lot of times we've gotten used to cryptocurrencies being incredibly volatile. You're seeing sort of a compression in volatility, if that's a way to describe what I've seen from cryptocurrency. So Bitcoin sort of at the upper end of where it's been the last 24 hours, still below 20,000, which is a really important level to pay attention to. Ether getting right up to that 1,300 level, which has been resistance here recently as well. Let us look at a chart of the S&P 500. I was on Fox Business earlier today talking with Charles Payne, and we talked about a chart very similar to this. And he was just talking about, where do we go from here, right? What happens? And I think that is the point, right? Take a step back from your monitor and just think about the overall trend. What can you learn from a chart of the S&P 500? In my opinion, I think we're learning that the trend is down. Most recently on the S&P 500, on Microsoft and a number of individual stocks, you had that big update last Monday. That was Monday of last week. Then a gap higher on Tuesday, Wednesday, Thursday, all right around in the same range. Then a gap higher on Friday when the market really weakened out going into to the weekend. That creates what's called an island reversal pattern, which is a gap higher, sort of this, couple days chopping around this area, and then a gap back lower. So imagine it like a map, and you're looking down on this little island sticking out from the mainland here. And that's a reversal signal, right? That basically tells you that there was a gap higher, but then a gap lower, and the direction of that second gap is what is most likely going to happen, because there was a gap higher for some reason. Again, the reasons don't really matter. There was a gap higher for some reason, then a gap lower that completely negated that move. So whatever excited investors here completely was gone just a couple days later. Now we're making a new closing low for the year today, finishing below 3,600, indeed getting down to 3,577 for the S&P 500. That's a new closing low for 2022. I have learned to not get too excited about a chart when it keeps making new closing lows. I've learned to get excited when it stops making new lows. And so that's why on a chart like this, on a chart of Microsoft, I'm seeing a weakness rather than strength. One of the things I was sharing recently was just the chart of Microsoft. How bullish do you want to be when Microsoft is making a new low? Now, that's not to say that certain things can't do just fine, right? Look at the average energy stock. Look at DVN or Oxy or Hess or FANG. Or COP or any of those, and you'll see a chart that's holding up there pretty well, and maybe not at a 52-week high, but really, really close, kind of holding in there, chopping around a little bit, but in a position of strength overall. So certain areas of the market can certainly do fine, but when Microsoft, when Apple, when Netflix, when some of these larger mega cap names that are a big weight in the S&P and certainly in the NASDAQ, when they're making new 52-week lows, it's just remarkably difficult for the major averages to mount any sort of upside potential. After energy, which was the leading sector today, up 0.8%. After that, consumer staples up 0.6%, then consumer discretionary up 0.25%. Everything else is in the red. Utilities and real estate really struggling. Utilities have been a tough go, and real estate as well. Those are two fairly defensive sectors. So again, on average, if you told me that the market was making new lows, if you told me that it felt like investors were getting defensive, I would immediately think to look at utilities and REITs as good places to hide out, because they tend to be lower volatility, higher income component, higher dividend. So it's a great way to ride things out. The problem is interest rates are so high that you can get interest in a lot of different places. You can get income in a lot of places. You don't have to go to utility stock necessarily to do that. The price so far, and particularly the relative strength, certainly turning lower here in recent weeks. Let's take a quick commercial break. We'll be back with my guest, Art Hill. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We really appreciate you joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Arthur Hill. First off, we welcome your questions. We did a mailbag segment on yesterday's show, some really thoughtful questions. We'll do another one at the end of the week on Friday's show, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. Keep the great questions coming. We'll get to as many of them as we can. We'll hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We are so fortunate to have people like Art Hill, Larry Williams, who just dropped a new market update today on our on-demand chat platform, as well as on YouTube, and so many other great shows every day, every week on StockCharts TV. You can access all of them for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Arthur Hill. Art is coming to us from Belgium, so I appreciate, Art, you staying up a little later for us and sharing some expertise here with TrendInvestorPro. Good to chat with you again. How are you?
Very good, Dave. Thanks for having me. It's great to be on the show. I've been looking forward to this.
It's good to see you. We're starting with a table. You and I were talking before we went live. Is there anything in an uptrend you managed, I think, to find some opportunities for us? Talk us through this table. What are we looking at?
Well, one thing that happens when you have a bear market, you tend to get rising correlations. In other words, especially with stocks, anything that is stock related is vulnerable in a bear market. And sooner or later, they get taken down. I was following the clean energy ETFs in August and in early September. They were outperforming, but they got taken down over the last 6 weeks or so. So they succumbed to the bear market. And so in order to find something that was not correlated to stocks, I did a little tool here on StockCharts. It's the correlation coefficient. And you can choose the number of days that you want to do. I chose 50. It was basically 41 days ago that we had the mid-August peak in the S&P 500. So a lot of stuff came down over that 40 days. And by using this correlation coefficient, I can find ETFs in particular that aren't correlated to the S&P 500. And so if it's a negative correlation, that means it's moving in the opposite direction as the S&P 500 is over the last 50 days. Now, even energy, which is outperforming, as you mentioned, still has a slightly positive correlation. So I had to really go down deep to find ETFs with negative correlations. And you can see from that list, we've got energy up there with a 0.16 positive correlation. But to get negative, you got to get to palladium, which is an industrial commodity, coffee, but coffee was hit today. Its chart doesn't look good. Turkey, I'm not interested in equities because most global equity markets are in bear markets as well. Corn, wheat, and then the dollar. The dollar is the king of the negative correlation right now. But palladium kind of caught my eye when I went and looked through these charts as something to possibly look at. So on this next chart that you'll see, it's going to be palladium. I've got a couple of indicators down at the bottom, and they're 200 days. So we've got the 5-day rate of change of the 200-day moving average. And that tells you when that moving average is turning up. And you can see over on the right, or your left maybe, that has crossed my threshold, which is 0.30. So I'm not looking for a cross above and below that zero line. You're going to get whipsaws. And you need to put a little filter on your bullish and bearish threshold so you don't get whipsaws. And so that one has crossed and turned bullish. And then the other one's just the 5-day above the 200-day. And I look for it to get above 5%. And if it goes below minus 5%, then that's enough of a cross of the 5-day below the 200-day to turn bearish. So when I ran this scan on these two indicators, only 10 of 274 ETFs came up as having uptrends. And you look at palladium there, you can see the rising green dashed lines. That's a rising channel. It fell back over the last few days. It's not exciting, but hey, it's not going down like the S&P 500. So if you're looking for a place to hide, this is one of the better places possibly.
I was told it's always a good time to own good charts. So I feel like if you're looking for something, right, I might as well own something where the technical situation is a little more attractive than the major averages. It's really helpful. I only have about a minute left, but I'd love to just think as we look at the S&P, some of the major equities making new 52-week lows today. Where are you in terms of thinking about between now and year end? Is there a particular chart or a particular indicator, a particular signal that would help you to recognize if and when a bottom may be in place here?
Well, I would turn to breadth indicators, and not some of the longer term ones, but say percentage of stocks above the 50-day moving average, percentage of stocks above the 20-day moving average. If we can get a thrust out of those, and as you pointed out earlier, November, December, very bullish months as far as seasonality is concerned. But seasonality is second to price action. It's the price that ultimately pays or makes or breaks your trade. But that's what I would look for, is some sort of breadth thrust from those two indicators, and maybe a 10-day moving average of advanced decline percent surging, something like that.
That's a great take. And I love that idea. Price over seasonality. When in doubt, let's follow the message of the markets. Arthur, it's great to see you as always. Thanks so much for joining the show. I know it's a little later for you, and we really appreciate it. Be well and stay safe there in Belgium. We'll talk to you again soon.
Thanks for having me on, Dave. Take care.
That's Art Hill. Art's a longtime StockCharts contributor. Does a fantastic job with his blog, which you should check out for sure. He has a plugin on our ACP environment. The chart that he shared with you of Palladium features some of the indicators from that ACP plugin. So if you like his methodology, which I certainly would encourage you to do, check out his ACP plugin. Some really interesting insights you can draw by analyzing the market through his lens. Great take there from Arthur Hill at Trend Investor Pro. Let's continue on our show with our next segment. Banking on breadth. What we like to do, and again, I couldn't have scripted that. I swear I did not feed that into Arthur, who said, all you need to do is look at breadth, because I'm thinking perfect, because we just happen to have a segment coming up, digging into breadth indicators. How well did that work out? But what we'd like to do with market breadth, again, in terms of priority, I think of three things: price, and then breadth, and then sentiment. I want to look at price first and make sure I understand the trend in the market. That's why market trend model that I use is the first thing I look at every day. Second to that is breadth, which confirms or denies what you see in terms of price. What are the stocks that make up those indexes? What are those actually doing? The third piece of that is sentiment, things like survey data, put call ratios, the VIX. Those for me are sort of that third piece down the row, and it's meant to more confirm or validate some of the other things that we're seeing. So let's look at the measure of market breadth. And it's interesting, the first chart in my breadth chart list is all red, and that is a subjective color coding, to be clear, but that is a color coding that I update every Friday. I basically look at this chart and just make a quick visual assessment. Are these things going up, going down, or going sideways? And just like a stoplight, I color code the four cumulative advanced decline lines to acknowledge the trend that I feel that they're in. All four of these are red, and they have been for the last couple of weeks. And the reason is because they have all broken below their June or their July low. Some of these made a new low in July. Others didn't undercut the June low, but all of these have made a new low for the year. So while the major averages are making new 52-week lows, while the advanced decline lines are making new 52-week lows, we can say this is a bottom, but I will tell you that we can't confirm it until well after when the breadth conditions start to turn higher. So at this point, it tells me we are certainly very, very much still in a downtrend. Next chart would be advancers, decliners. Actually, let's skip that one and go to this one. When I asked Art about what chart he would look at, it was something kind of along the lines of this one, which is looking at the percent of stocks above their 50-day, the percent of stocks above their 200-day. And we have a number of indexes on the StockCharts platform to track different groups of stocks, like the S&P or the NASDAQ or the New York Stock Exchange, whatever you want to look at, and also different moving average combinations that you can do. And by looking at these different breadth indicators, we can get a better sense of where the leadership is, what is performing well, what's performing poorly. This is my main way of measuring it, which is how many stocks or what percent of stocks in the S&P are currently above their 50-day moving average, right around 10%. It's one of the lowest readings we've seen, obviously, in a number of years. In late September, we got down almost to zero, single digits. Back in mid-June, we got down to single digits as well. Back at the March 2020 low, we actually got to single digits, stayed there for quite some time, and even touched the zero level just briefly there for a couple days in March of 2020, essentially right at the low. So while it's very, very low, meaning 90% or about that of S&P members are below their 50-day moving average, you also looking back at cyclical bear markets, what you'll note is that that's often not the end, right? These indicators can get to zero or get to single digits and stay there for quite some time. You saw that in 2020. You definitely saw that back in like 2008, 2009. These indicators crater and then just remain very, very low for quite some time. 16% of the S&P 500 members are above their 200-day moving average. So to summarize, these are both obviously very, very weak, suggesting that is a broad decline. It's not just some stocks going down, but it's almost everything. When those things start to stop making lows, right? When they stop going down, that's when you can start to get interested in the market. And again, I would caution you by saying, all right, it was so low in September. Obviously, that's a bottom, and that's where we bottomed out in June. You could argue we sort of bottomed out in 2020, but just remember the first time we got down to that level was in late February. We went down another 3 weeks and quite a bit in terms of price behavior. That's the S&P going from 3,000 down to 2,200 before we actually made a low. So be wary if you find yourself tempted to buy because of weak breadth. Weak breadth often begets weaker breadth, right? As the trend continues lower. Bullish percent indexes for the S&P 500, for the NASDAQ 100, both remain in a confirmed bearish phase, which is below 30. That tells me that it's a confirmed bear market phase. You can see with this little orange, red highlighted circle, every time that the indicator had been above 70 and then went back below 30, and that has basically usually not been at the bottom. It's usually been well before the bottom. We can see that with a number of conditions. So we first actually triggered that in the third week in September. We've obviously continued to go much, much further after that. I want to talk briefly about the McClellan oscillator. I'm just finishing up some of the work on our market survival kit, part of ChartCon 2022. For our StockCharts members, we agreed to share with you a market survival kit. And I think 10 of our presenters all share different charts or different indicators that they are using right now to try to make sense of these markets between now and year end. We're going to give you all of the replays of ChartCon, but also all of their charts with some comments from each of them, sort of explaining the methodology. And I think as a whole, it's a brilliant survival kit. It is literally your first aid kit, your emergency pack that you take with you as you're hiking through the wilderness of the markets. The reason why I went through that whole thing is because Mark Chaikin, one of the first charts you'll see on that list, was Mark Chaikin's chart. He had a number of different things on there, but one of them was, I believe, the McClellan Summation Index. Now, the McClellan Oscillator is sort of a derivative of the advanced decline lines. Those 4 red lines that I showed you a little earlier in this segment, which are the cumulative advanced decline lines. The McClellan Oscillator basically takes moving averages of those advanced decline lines and turns them into this oscillator, right? And so it's meant to rotate above or below zero. If it's above zero, conditions are strong. If it's below zero, conditions are weak. That indicator is then translated into a cumulative indicator of its own called the McClellan Summation Index. Long story short, where is the trend? Is it going up? Is it going down? Where is it at relative to previous levels? Made another new low here in October for 2022. Certainly went above zero in late July, continued to move higher, actually almost made a new high for the last couple of years there in August, but fizzled out and now making a new low. So the weaker conditions in the advanced decline line take the McClellan Summation Index, which is a key measure of breadth and breadth direction, very much firmly in the negative side. You know, I've often said to our getting to our next chart that bullish phases are marked by an expansion in new highs. Bearish phases are marked by an expansion in new lows. And when you look at this chart, it's a simple question. Do you see a lot of green or do you see a lot of red? When you see a lot of green, as you did back here in 2021, that tells you conditions are overall fairly constructive. Whether or not the S&P or the NASDAQ are making new 52-week highs, this is tracking stocks in 3 different universes that are literally making a new 52-week high on a particular day. So the more green you see, the more that individual stocks, again, whether or not the S&P is making a new high, individual stocks are able to do so. Right now, you don't see very little green at all, and you see a lot of red, which means just as the S&P is making a new 52-week low, a bunch of individual stocks are doing so as well. We're not updating this just yet for today. We're crunching the data right now after the close, but yesterday, which is not a huge down day, but certainly finishing in a position of weakness. Literally 20% of the S&P 500 members made a new 52-week low yesterday. I would expect that to be a little bit higher today. And overall, that is a weaker market. Just to finish off, let's talk about volume, right? I didn't update some of these annotations. I was looking at this chart just before we went live. I realized I hadn't updated this in quite some time. I will do that. But if you look at the trend in volume since mid-August to where we're at now. Look at the trend in volume in July coming off the June low. Uptrend in volume, a lot of high green days as you had up days on stronger volume. That's the sign of a healthy uptrend. Then all of a sudden, look at how that changed in August, where the market keeps going up. But look how the trend in volume is declining. So basically, we're going higher, but less and less volume, less gas in the tank, if you will, propelling the market higher. From mid-August to where we're at now, arguably, the trend in volume has been consistently positive. You see a lot of big red bars in there. A lot of down days in the last couple weeks or last month, and overall, the trend in volume has been increasing. So when the market's going down on heavier volume, that is confirming a downtrend. That is not a sign of a healthy market environment, or in my opinion, an argument for buying weakness. That's an argument to stay out of the way and watch the trend continue to deteriorate. On balance volume, which is an indicator that Joe Granville created a number of decades ago, really is a way of taking volume and stringing it together over time. Mark Chaikin's accumulation distribution indicator is a similar derivative, maybe even improvement on balance volume, but just look at the consistent downtrend, particularly in September to early October. So we have this situation where the market going lower. You've certainly seen volume support that. You've seen breadth conditions support that. And finally, you have indicators like the Zweig breadth thrust, which I highlighted when it initiated a potential buy signal. That is gone. It evaporated, right? The breadth did not get strong enough in the last week and a half to validate a new buy signal. So again, it's back to confirming the bearish trend. So arguably, I mean, I find very little in breadth to get me excited about a potential uptrend. I see plenty of evidence telling me that the downtrend most likely not quite done yet. We need to wrap the show. It's so fun to do the show, and we appreciate the opportunity to do so, but we've got to wrap it up and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. In my segment, banking on breadth, we talked about the McClellan Summation Index. This is just one of the great wealth of breadth analysis and indicators that we have on the StockCharts platform. Hit our support desk if you're struggling to find one, by the way, or the little magnifying glass in the upper right corner of our website should be your friend, particularly if you're looking for something like the McClellan Summation Index, the Zweig breadth thrust indicator, any of these other more obscure indicators you may not have heard before. Hit the little magnifying glass so you can see articles about those breadth indicators. You can figure out what the tickers are so you can incorporate them into your charts, and also contributors like Arthur Hill who have written and used some of these indicators. You'll actually be able to see what they've written going back over time. Very much still a bearish pattern for the McClellan Summation Index. Chart number 2, Wynn Resorts. I mentioned being on Fox Business earlier today. One of the stocks we were asked about, or I was asked about, was Wynn Resorts. And my comment to them was, look, this was a potential head and shoulders bottoming pattern, a low surrounded by 2 higher lows. We broke the neckline here. It's about a week ago, raging buy signal, right? And absolutely, I would agree that was a valid breakout using an inverted head and shoulders methodology. But look at how quickly that reversed. In bull market phases, stocks hit resistance and then plow right through as they go on to make new highs and go onward and ever upward. In bear market phases, stocks that it looks like should break out often fail and come back down. And that shows you there's an evaporation of buyers. There's not enough buying power to follow through on some of these patterns that have stood the test of time. That's another confirmation the patterns are weak. Arthur Hill, I thought, did a great job just talking about the message of price versus seasonality or any other things. When in doubt, follow the trend in the market. I have to acknowledge some of these cruise lines like RCL, I'm hesitant to take on any risk in this environment. I still think it's very much a risk-off environment, but I have to note when a stock makes a low and then makes higher lows, and you find a pretty good support level at around 37.50. That was tested in August, once again tested at the end of the last month, now rotating back above the 50-day. Like to see a stock making higher lows potentially. Is there an opportunity somewhere like that? Maybe, but keep a wary eye on risk. Folks, that's a wrap for this show. I want to thank Art Hill joining us from Belgium at TrendInvestorPro, sharing some thoughts with us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.